IFRS 2 Share Based Payment. In February 2004, the International Accounting Standards Board issued IFRS 2 Share Based Payment. In June 2016, the board issued Classification and Measurement of Share-Based Payment Transactions, amendments to IFRS 2. Objective. The objective of this IFRS is to specify the financial reporting by an entity when it undertakes a share-based payment transaction. In particular, it requires an entity to reflect in its profit and loss account in financial position the effects of share-based payment transactions, including expenses associated with transactions in which share options are granted to employees. In simple, this IFRS specifies if any type of goods or services has been received by an entity from a supplier on the basis of shared base option, he must need to record these transactions in his books of accounts as expense or asset, and record the second affect as liability, or equity settled share-based payment transactions. Let's take a look how these transactions are treated and recorded in the books of account under IFRS 2. Objective. Specify the financial reporting by an entity who undertakes a share-based payment transaction. Entity shall reflect the effect of these transactions in its profit and loss account in statement of financial position. Who undertakes a share-based payment transaction? Supplier. Entity. Goods/services. Share-based payment arrangements. As this diagram is showing, who undertakes a share-based payment transaction, it can be like this: supplier will provide goods or services to an entity. This entity can be a person, group, or a company, who undertakes the supplies, under shared base payment arrangements. What is shared base transaction? It is a transaction in which the entity receives goods or services from the supplier. Of those goods or services, include an employee in a share base payment arrangements, and will define in minutes. So if this is the case, then the entity must apply IFRS 2 for reporting this shared base payment arrangement. Scope. An entity shall apply this IFRS in accounting for all share-based payment transactions, whether or not the entity can identify specifically some or all of the goods or services received, including: Number A. Equity settled share-based payment transactions. Equity settled share-based payment transactions. Number B. Cash settled share-based payment transactions. Cash settled share-based payment transactions. Number C. Transactions in which the entity receives or acquires goods or services, and the terms of the arrangement provide either the entity or the supplier of those goods or services, with the choice of whether the entity settles the transaction in cash, or other assets, or by issuing equity instruments. With the choice cash, or other assets, or by issuing equity instruments. Settle the transactions. Share-based transaction is also a transaction in which an entity incurs some obligation to settle the transactions with the suppliers, as share-based arrangements, when another group entity receives those goods and services. Supplier, goods/services. Group entity, shared base payment arrangement. So here another group receives the goods and services, but if the liability to pay for him on shared base payment arrangements is transferred to an entity, then IFRS 2 applies to that entity to pay. Entity. Under IFRS 2, if any good has been taken by any other group or entity, the entity who has made these arrangements is liable to pay the supplier. In simple, has obligation to settle the transaction with supplier under share base payment arrangements or cash basis. Share-based payment is an agreement between the entity and another party, supplier or anyone else, that entitles the other party to receive. Share-based payment is an agreement between the entity and another party, supplier or anyone else, that entitles the other party to receive the payment or settle the transaction by any mean. Agreement between the entity and another party that entitles the other party to receive. Cash, other assets. For the amount based on price value of equity instruments. Cash settled. So in this case, supplier gets paid against goods and services by cash, but the amount of cash is determined with the reference to instrument price. These transactions are called cash settled. Equity instruments, including the shares or share options. Equity settled. This is the common way to remunerate some employees of the company, receive shares in return of their work for the company. These transactions are called equity settled. It is very important to determine whether you are dealing with cash settled or equity settled transactions, because accounting treatment depends on this. If transaction is other than cash settled, we need to know vesting condition has met. There could be also vesting condition, and these are service or performance that the other party must fulfill before being entitled to share-based payment. For example, director might be entitled to receive the shares of the company after 5 years of their service. These 5 years are vesting condition. Recognition. When to recognize the share-based transactions. When an entity shall recognize good received. How to recognize the share-based payment transactions. Number 1. When to recognize the share-based transactions. When the goods are obtained by the entity. As the services are provided. Our first question is when to recognize the share-based transactions, and an entity shall recognize good received. When the goods are obtained or handed over to an entity and when the services are provided. How to recognize the share-based payment transactions. How to recognize the transaction that depends on the type. If the transaction is cash settled or the entity pays in cash, based on price and value of that instruments, then it is to recognize goods or services received. How? Cash settled. Equity settled. If transaction is cash settled, our accounting entry will be like this: debit, assets or expenses account; credit, liability account. For example, debit inventory or property, plant and equipment, or expenses account in correspondence; credit recognize liability account. Equity settled. Debit entry will be same like before: debit, assets or expenses account. Credit side effect will go to equity, if transaction is other than cash. So credit the equity account. These are the basic recognition criteria, and let's bring down the more specifically in line various types of transactions. Let's take a look on equity settled share-based payment transactions. Equity settled share-based payment transactions. There can be employees, suppliers or any other party, who has provided services or goods to the entity. The entity is liable to pay employees and other parties against their services, those who have rendered or provided services and goods. In exchange, entity can pay the second party in some own equity instruments such as shares or shares options or anything like similar. An entity acquires goods or services from the suppliers, including the employees, and pays for the services in some own equity instruments, such as shares or shares options or anything like similar. How shall we measure such a transactions? Measurement. The basic rule is to measure the amount of goods and services received, in correspondence payment on equal to fair value of goods and services received at the receipt's date. At the fair value of goods and services received. Well, this approach is common when an entity acquires good or services from third party, where it is possible to determine the fair value of goods and services. However, entities very often provides share-based payments, part of some remunerated package to the employees, and in such a case it is very difficult, to even not possible, to determine the fair value of services received from the employees. Therefore, IFRS 2 requires the using of fair value of equity instruments granted instead. In simple, if fair value of employees' remuneration is not possible, in this case we can determine the fair value on the of basis equity instrument granted. If not possible, fair value will be equal to equity instruments granted. So instead of determine the fair value of employees' services, an entity should estimate the fair value of its own equity granted. IFRS 2 provides the whole guidance how to do it, Basically, this fair value is estimated at the grant date, not at receipt date. Vesting conditions. In this IFRS we will learn that what are vesting conditions. As these remunerations are usually provided in exchange of the employee services over some period, while there is one more thing to keep in mind: vesting conditions. Share-based payment is vested or not, so if these benefits are not vested, it means these are granted immediately, and the counterparty is not required to complete the specified period before to becoming the title to those equity instruments. Well, in this case IFRS 2 sees these remunerations in return for past services, and therefore an entity shall recognize the services received in full at the grant date. Vesting. Vested. Full recognition. If vested condition has fully vested, then we can recognize the full value of the transaction. If vesting period has not vested, then we will recognize each year with vesting period. Over vesting period. With the correspondence increase in equity. However, if these benefits are not vested, then the situation is different. In such a case, counterparty required to complete the specified period of service. For example, an employee gets 100 shares of his employer after 3 years of his service. IFRS 2 regards these shares to be provided for the future service over the vesting period, and therefore the services are recognized over the vesting period, with the corresponding increase in the equity, so vesting conditions are not reflected in the fair value of one share granted. Instead, they are reflected in a number of shares that an entity need to recognize each year of vesting period. Let me also add, IFRS 2 prohibits subsequent adjustments to total equity after vesting date, but it allows transfers with individual equity components. For example, some shares options are not exercised. An entity does not reverse share option right, but adjust the situation as transfers to the equity. Cash settled. Shared base payment transactions. Let's take a look. Cash settled shared base payment transactions. In these transactions, an entity acquires certain goods and services from the suppliers, including employees, and pays for these services with cash or other assets, in amount determined by the reference to own equity instruments. For example, share appreciation rights, where employee gets payment based on the entity's share price increase, or the rights to mandatory redeemable shares, as these transactions are typically income as remuneration of an employee. Measurement. Let's focus on measurement of share appreciation right, as this is cash settled transaction. The credit side of the entry goes to liability, not equity, but we mentioned that liability at fair value. This liability shall be measured at its fair value on its initial recognition, and the fair values of liability from share price shall be determined by the application of auction pricing model, taking into account specific conditions. The liability shall be remeasured at each reporting date until settled. Vesting conditions under cash-settled shared base payment transactions. So this is the big difference from equity-settled base payment transactions. Of course, share base appreciation arrives both vested and non-vested, and here rules are similar to equity-settled base transactions. If these are not vested, employees are entitled to them without further conditions, then an entity shall recognize them fully at the grant date, and if these payments are vested and certain conditions are, further period of service is required before the entitlement, then these shall be recognized over the period of vesting. Modification, cancellation, settlement. This standard IFRS 2 deals also with other issues related to share-based payments, such as modification, cancellation, and settlement. IFRS 2 requires certain disclosures and provides the guidance on measurement of shared-based payments transactions. This is the short summary of IFRS 2. Thanks for watching. If you like this video, please thumbs up and subscribe my channel for more useful videos.